Good morning, everybody. This is David Marsh. I'm the chairman of OMFIF, and it's a great pleasure to introduce our latest ARM seminar on asset and risk management around the world. We've been doing this now for many years, and this is certainly the most dire moment at which we are doing this. Thank you, everybody, for joining us. It's a pretty wretched time for the world economy, and particularly for the situation in Europe. So I'm just going to say a few opening remarks before handing over to my friend and colleague Neil Williams to take us through the first session, and he will describe to you how the morning in London and European time will work for everybody. Just a few remarks to set the scene. We've had a lot of action in the last 2 weeks, and many of these are actually striking out new frontiers and new boundaries. If I can just mention one or two, we have a hot war in Europe, the biggest hot war since 1945. There have been outbreaks before in former Yugoslavia, for example, but this is without doubt the largest and most significant and most important and possibly the most devastating. We have a great refugee crisis where Poland at the moment is on the front line. This is the biggest refugee crisis in Europe since the movements at the end of the Second World War. Coming closer to home in our own area of economics, finance, monetary affairs, we have the extraordinary freeze on Russian official assets, rendering worthless quite a large part of the $600 billion plus in gold and foreign exchange reserves of the Central Bank of Russia. We have the new pronouncements on trade and financial and investment sanctions against Russia, which are very comprehensive and seem to be getting bigger by the day, an attempt to isolate the Russian regime, although hopefully not the Russian people, from what is going on in Ukraine. We have the new emphasis on energy security in Europe, which is leading to a substantial rethink in the way that Europe is looking at its imports of oil and gas. That's going to have monetary and financial implications. We're looking at inflation becoming embedded. We've already had a lot of talk about this in the past 12 months, but it now seems to be for real. Inflation is back to stay, not least because of this spike in energy prices, which clearly now seems to be semi-permanent. We've had a rethink about armaments. This has a big impact, I would say, also on the whole ESG question. We've had a rethink about nuclear power as well. That also applies to the ESG issues, which we're going to be talking about. And then if you talk about the role of central banks, which we're going to be thinking about, particularly in the first session, they are in a very difficult position indeed. And we'll be looking at the different aspects of the ECB in particular and the Federal Reserve, where the Federal Reserve seems to have a slightly more straightforward stance when it comes to raising interest rates to combat now the 5 to 6% inflation rate we see in the United States. A much more difficult job for the ECB, where almost anything they do on Thursday when they have their next governing council meeting is likely to be wrong. So a very unpleasant and disagreeable cocktail of questions for us to be looking at. So Neil, who has joined us now as chief economist, having been working at Hermes Asset Management for a decade and being a great friend and a client of ours, has now joined us. We're very pleased to say that. So welcome, Neil. You will be guiding us through the first session, which is about the growth outlook and the investment landscape. So over to you, Neil, and I will be coming back in right at the very end to deliver some summing up remarks. So looking forward to what everybody has to say. Thank you all very much indeed for joining us today. Over to you, Neil.
Well, thank you, David, and a big welcome to everybody joining us at our seminar. It's perhaps to borrow a footballing term, we're hoping for a game of two halves with lots of excitement in both and a few goals scored. As David suggested, we live in interesting times, but of course we live in tragic times, and our thoughts go out to those affected. But in terms of balance sheet management, economic policy and macroeconomics, it could not be perhaps more timely to have this discussion. It is, I would say, on the record, but we're hoping it's going to be as interactive as possible. And given our amazing lineup of speakers, I would be very surprised if we're not flooded with questions. Just very briefly from me first on the macro front, one thing that keeps me awake at night, you could say, is that given the various macro strains, not just this year or even this decade, but beyond that, how central banks now can even begin to go down the road to normal, to get monetary policy and governments too, to get fiscal policy back to the sort of historic norms that we might expect. Firstly, if we are now looking at a stagflationary period, if that is the case, and secondly, the increase in balance sheets across the world since 2008 in particular, given that if you take the big four central banks, the liquidity injection to the private sector since then has been huge, equivalent to about 95% of US GDP, or about 1.25 times China's, which suggests to me, to borrow an American term, that the big central banks now have their own skin in the game. If they take us off guard by perhaps tightening a little too aggressively, then surely their own balance sheets and indeed government finances will be affected. So I wonder if we are going to get anywhere close to where markets currently assume in the US and in other economies, central banks can start to ratchet up rates. We will perhaps learn more in the months to come. But today, without further delay, I'm delighted to introduce our high-level panel. We have Gioia Celai from the Bank d'Italia, who heads up the Market Operations Directorate. Also Juliusz Czablecki from the National Bank of Poland, who's head of Risk Management and Strategic Allocation. And also Carl Malandres from Banco Central Filipinas, who heads up the Reserves Management Department #1. Delighted to have everybody on board. And I would just say that back of the envelope, if you add up the foreign exchange reserves that these three people are partly responsible for, you get something approaching $500 billion US worth. So these are no small jobs. And when these guys speak, I think it's worth taking notes. So I'm going to ask them, please, perhaps for your preliminary comments, which I know will probably take about 10 or so minutes. The stage is yours. And I think a couple of you will be using some charts. I would perhaps hope that you could possibly weave in on the way, if you could. Firstly, how do you do what you do day to day? And secondly, how, if at all, recent and current events have been shaping your thoughts and your actions. So I very much look forward to that in this first half of the match. And perhaps, Juliusz, I can turn to you first, not just because of your contagious enthusiasm for the subject, but also because perhaps the relative proximity, at least geographically, to the current crisis. So Juliusz, over to you.
Thank you, Neil. Can you hear me? Can you hear me okay? All right. So hello, everyone, and thanks for this very kind introduction. So I thought I'd start with a quote I've seen in one of the research notes recently, and the quote is attributed to Lenin, V.I. Lenin, not John Lennon, V.I. Lenin, mind you, which I realize is not an ideal source in today's circumstances. But anyway, the quote says something like that: there are decades where nothing happens, and then weeks where decades happen. And I guess we've just experienced a couple of such weeks, with probably a couple more ahead of us. So it's frustratingly difficult to offer sensible thoughts on where we're headed right now. But I know Neil wouldn't let me off the hook so easily. So I prepared a few slides to save my skin and at least provide some context for discussion, and then, perhaps we can go back and forth in a little while. So let me start by offering a view on NBP's FX reserves portfolio. Next slide, please. So with about, as you can see on the left-hand panel, with about 120 billion, we are probably a medium-sized reserve manager. Mind you, what you see on the left-hand side, that's not all of our so-called official reserve assets. That's just the part that we manage and actively invest. So the full reserves portfolio, including the SDR, so the IMF, claim on the IMF, gold held in NBP vaults, and also Ministry of Finance funds, would probably, so if you add up all those items that I've just mentioned, with it, probably reserves portfolio would be probably around 150 billion. But 120 is what we actively invest. And of this 120, roughly 87%, as you can see in the middle, 87% forms our actively managed portfolios. And as you can see, we also have a small, smallish long duration portfolio of securities, which we designated as held to maturity. And then we also have a small portfolio, roughly 5% of investable gold. So once again, our total gold stock is probably closer to 10% of our reserves, but half of it is stored domestically and is not investable. Only half is held offshore in the Bank of England, where we seek to actively invest it. The held to maturity portfolio is made up of U.S. Treasuries, long duration U.S. Treasuries. We created this portfolio last week as part of our effort to protect our balance sheet against rising yields, or what we thought was a trend of rising interest rates globally and specifically in the U.S. And we wanted to reach out to sort of pick up a slightly higher yield, but also protect our P&L from adverse consequences of valuation changes that would materialize necessarily if and when interest rates do finally increase. So now if you take a look at the rightmost panel, you see our the composition of our investment portfolios. Well, I think the first thing that you see, and it's not just because I've opted for a very colorful picture, but what you can see is probably that our reserves portfolio is quite diversified. We have allocations currently to 7, non-trivial allocations, I should say, to 7 different currency portfolios. So our largest exposure is to US dollar, then followed by the euro, sterling, and the CAD, Canadian dollar. And on top of that, we also hold Australian and New Zealand dollars, as well as Norwegian krone. So the vast majority, as you can see, is in fixed income instruments. But recently, we have sort of acknowledged the lower for longer story, and we've also added an equity exposure to our 3 of our largest portfolios, so the US dollar, the euro, and the pound. This was our this was a way to also diversify while diversify risk, but while seeking slightly higher returns over the longer time frame. Now, of course, we didn't arrive at such a currency structure immediately. If we could go to the next slide, please. You can see it actually took us quite some time, and in fact, the process of diversification was stretched out over more than a decade. As you can see in the left-hand panel, back in 2006, we started out with just 3 core currencies: US dollar and euro, roughly in equal proportions, so 40–45%, and then 15% allocation to the sterling. And gradually we began opening up, first adding the Aussie, then the Norwegian krone, then Kiwi, and finally last year we've added the Canadian dollar. And as you can see on the right-hand panel, the diversification process has mostly worked out well for us, consistently adding income through interest rate differential. That's the green line over there, so the yields effect. And this income and this yields effect has partly been offset by FX valuation effects. So in a way, if you will, you can look at this as a classical carry trade story, where part of the yield pickup is consumed by FX valuation changes. But let me be overall, of course, net, we're in the positive territory and happy to be there, and our risk is substantially reduced. But I want to be very clear. Of course, the excess return makes us happy, but our main intention throughout has not been to chase transitory effects movements, but rather to we strive to build a resilient portfolio that would effectively diversify FX risk, which is, by the way, the main driver of the P&L volatility of Narodowy Bank Polski, Polish central bank. Okay, so now that I've told you a little bit about the structure of our portfolios, we can turn to the main theme of this panel. And if we go to the next slide, we can finally address what I have somewhat bombastically perhaps called the great post-pandemic repricing. So the extent of the shift is illustrated by these two charts, and these are the charts that I had to select some, so I just went for the two most prominent asset classes that we hold: fixed income and equity, and it's both U.S. Treasury bonds and U.S. equities. So the left-hand panel shows the change in U.S. Treasury yields now relative to 2020, and the right-hand panel shows similarly the change in U.S. equity valuations in a time series fashion. So back in 2020, when those of us who were not struggling with COVID, we were concerned about just how low yields have come down, and the general belief at the time was that rates would stay low. So hence this lower for longer theme, and the general story was, well, that interest rates have come down so low, so much that in fact they're at levels that are no longer perhaps consistent with capital preservations, given that they were consistently lower than rates of inflation across many markets. We're no longer in that territory. But back in 2020, central banks and NBP among them have veered and started looking for ways to somewhat increase returns, and part of that move from our side was to allocate a portion of our reserves to equity portfolios, with a view of improving our risk-return profile in the long run, and it seemed like a no-brainer, really, because the stories that you could find, and many pundits were arguing, scholars even were arguing, that the traditional 60-40 stock bond portfolio was already dead in the water, with so low bond returns. One thing that did concern us was that equities did have very high valuations, so we were a little bit concerned whether the timing was great. But then finally we decided to go for it anyway, because we thought we were doing this for the right reasons, for strategic reasons, and with a long-term view, and that kind of made the timing slightly less important for us. Now, things have changed in a space of, as I said, in a space of a year or so. Things have changed tremendously. Yields are 100 basis points, somewhat higher than, give or take, 100 basis points higher along the curve. Especially the short end of the curve has come up, and equity valuations have come down, and the net result of these two changes, if we can go to the next slide, please, we turn to next slide. The net result of these two effects is that if we look at medium-term return, expected return forecasts for a sample treasury portfolio that corresponds to the maturity that is likely to be present in any central bank's portfolio, so like 3 years maturity perhaps, the expected returns on such a portfolio have climbed up by give or take 100 basis points. It's similar because valuations have improved slightly, meaning the S&P 500 is not so ridiculously expensive anymore. The expected return has increased somewhat. Now, with returns, with bond portfolio returns, traditional high quality, so highest quality U.S. Treasuries, expected return over, say, 5-year horizon, standing at 1.4%, up from 0.6. That's that's not so bad at all now. The U.S. broad market which is slightly higher duration, well, twice that high actually. Long-term return, we see long-term return at around 2.3%, and for investment grade corps, that's again for the U.S., which again also has slightly higher duration. That long-term duration is even 3.2%. So, with these in such rates in such rates environment, the difference, the spread between equities and bonds is not so big. I mean, it's declined, so it's narrowed somewhat. So I would say back in 2020, the story was Tina. There is no alternative to going for non-traditional assets. There is no alternative because non-traditional assets are the only ways you can boost returns on your portfolio. Does Tina still hold after the repricing? I would say yes. The case for continued diversification and seeking for ways to boost your returns is solid. I would say it still holds, but my guess is the relative attractiveness of bonds has increased. And while many of us have looked in desperation at their fixed income portfolios, seeing how the rising yields have eroded mark-to-market values, well, you can find at least some consolation in the fact that at these higher yields, expected returns are also higher, and they are not far below equity returns, expected equity returns in the US at least. So having said that, I'll stop here maybe, and if we want to turn back to any of these slides in any time during the panel, of course, I'm happy to take any questions. Thank you.
Julius, thank you very much for that very smooth overview. There's a lot in there that of interest, and I guess it's fascinating that the equity bond yield gap, at least for the S&P, sort of crashed back down with lower volatility around the time at the beginning of 2020 when fiscal packages start to come in. The question, I guess, now is whether they will be removed. I just got one question for you, if I may, and please do continue to send your questions in on the chat line before we go to Joya. And the question is the long-term return has increased thanks to rising yields, but return in the short term has turned negative. What was the reaction to negative returns in the first part of 2022? So not so much 20, but the first part of this year.
You mean my reaction?
Yeah, if you could, unless you want to wait for the other panelists.
Dogs may bark, but the caravan goes on. No, seriously though. I mean, the reaction was okay. I mean, sure, we are experiencing transitory valuation shocks, adverse shocks. That's not pleasant, obviously. But this is, you know, if you are effectively a duration targeter. So if you are an institution that tries to maintain fixed duration of your portfolio, which is what we do, which is perhaps most central banks do, then you needn't worry so much about these valuation changes, valuation effects, because as the duration of your portfolio shortens throughout the year, you sell some of the bonds and buy some new ones at higher yields, and that's that's and that underlies the and what this effectively does is that your higher interest income makes up for the valuation losses, because you change the profile of bonds in your portfolio to maintain constant duration, and therefore the higher income buffers out over the long term. The higher income that you earn buffers out the negative valuation losses that materialize in the short term. That would be my response.
Okay, thank you. And just one more question to you, please, before we go to Joy, because you're stimulating a lot of interest. Do you plan to increase exposure to the US as interest rate differential rises?
You mean fixed income, or broadly speaking, I would say we have. So what I described in the slides, what I showed was. So maybe let me start with a short answer. Short answer is strategically no, tactically and actively perhaps. So the role of the benchmark is not to make bets on, as I said, short-term FX movements. It's there, the composition is there to deliver long-term stability. And sure, with higher interest rate differential between, say, the US and the Eurozone, it might seem like a smart move to increase allocation to the US dollar. But our problem is that the euro is, well, it's not only the most important currency for a European country, but more to the point, it is the best diversifier of the US dollar from our perspective. So we have very low volatility to the euro. When I mean volatility, I mean the volatility of the euro zloty cross. The euro zloty FX cross is much lower than the volatility of the US cross. So in fact, our move, if you look at the history of the changes in our reserves portfolio, it has been a move out of the US dollar, a consistent move out of the US dollar, because we have highest volatility on the US dollar zloty cross. And that's something we wanted to avoid. But that being said, we do allow for tactical shifts, plus minus 2 percentage points. We can accommodate movements. Our tactical investment committee can make shifts relative to the benchmark, and that is not only allowed, but is even encouraged. And we may look for such allocation in the future.
Okay, that's terrific. Thank you very much, Julius. Joy, if I could turn to you two now, please. I know you're hoping also to use some slides. If I'm right, Banca d'Italia is sitting on about over 200 billion euro worth of reserves, which you have a major hand in managing, and many years of experience at the central banks. If I could turn to you, please, and get your thoughts.
Sure, if you can kindly show the slides. And so first thing to do to figure out what Banca d'Italia does is probably to have a quick look at our investment portfolios. As you can see from the slides, these are old data because the latest available public data are the ones of December 20. So market values have changed this year quite a lot, but this is the most recent picture I can show you. Anyway, you can see our two investment portfolios. On the left-hand side, you have foreign reserves. So foreign currencies plus gold. As you can easily notice, it is a fairly large amount of euro equivalent, because at old prices, it would be 177 billion euro equivalent, including gold. Right now, gold appreciated quite a lot. And you can see that gold constitutes a major portion of our official reserves, roughly 70%. The remaining component, which is not small though, because it's roughly 50 billion euro equivalent, is mostly invested in US dollars, but also diversified in British pounds, Japanese yen, Aussies, Canadian, and then we have SDRs. And then we have another investment portfolio, which we call the financial portfolio, because it's mostly invested in euros. So consider it like mostly related to our own funds. It is a diversified and international portfolios because the euro is indeed an international currency. It's worth roughly 150 billion, and it is mostly invested in government bonds in euros, but it also has a fairly large equity component, which is currently equivalent to roughly 12, even more billion, between 12 and 15 right now at current prices. And we invest both in European equities and in international equities as well, US and Japan. So our investment policy is pretty, how can I say, traditional and stable. And still, I think it's worth spending a few words on the current context. And so if you can please move forward to the next slide. Okay, so I try to depict what we have been experiencing over the last couple of years with two pictures in terms of context. So pre-corona, we were like, we central bankers in our capacity as investors, we were like driving on an Australian highway, you know, straightforward, pretty smooth. You can almost use the automatic shifts, low vol, low interest rates, widespread positive returns because interest rates were often you know, you could also you could simply benefit of your carry and roll down effect on fixed income portfolios. Equity portfolio was performing well, and monetary policy were ultimately more predictable. So now I'm talking with my hat as an investor, of course, not as a monetary policy authority. Then there was a corona, and we suddenly moved to a much more bumpy road. And right now, what we see around us, we see, well, let's leave aside the war, but from a macro perspective, we see higher and stickier inflation. And on the markets, we see higher volatility and lower liquidity. And in general, we see much greater uncertainty. So, as an investor, Banca d'Italia has a very long-term oriented asset allocation policy. So if you move on to the next slide, I will show you how we build up our asset allocation. But I want to say that, of course, we are not indifferent to short-term developments because foreign reserves, so those 50 billion that I showed you before, are managed actively. So we are oriented to the long term while setting our investment benchmarks. But of course, we are very much targeted to capturing opportunities and to mitigate risks stemming from short-term developments while managing our actively managed portfolios. So let's leave aside for a moment active management and let's focus on our strategic asset allocation methodology, which is quite, I would say, peculiar. So we have an asset allocation model, which is proprietary, which we call asset and liability management model. Because with a long-term orientation, so if you look here on the right-hand side of the slide, low, you will see that we use 10. We generate our scenarios based on a 10-year horizon. This is why we're long-term oriented and we are pretty stable. Then we take our balance sheet, the entire balance sheet, and we sort of reclassify it in order to have a schematic representation of the whole bunch of central bank assets and liability. So what does the central bank have on the asset side? First of all, our foreign reserves and investment portfolios. We have all the huge amount of securities that we have been purchasing for monetary policy purposes. We have credit to banks. And we also model what we called a latent asset, and namely the income generated by saving rate, by the fact of participating to the creation of money. On the liability side, we have minimum reserve requirements. We have target to balances, And we also model as a latent liability the running costs of the central bank. Of course, the difference between the light blue assets and the pink liabilities is our economic capital. And based on this scheme, we consider that whatever is related to monetary policy on the assets and liability side and to costs is somehow unavoidable. The only component of this asset and liability scheme that we can handle, that we can steer, is the one related to investments. And so basically, the optimization is run in a view to minimize expected shortfall at 99% on the 10-year horizon, of course, compared to our economic capital. And we try to steer accordingly our investments because the rest is somehow given. So you can easily imagine that if you know the size of Banca d'Italia's balance sheet, which according to the most recent statistic data is like 1.5 trillion, and you have seen now the size of our investment, which is roughly 350 billion, you can easily figure out that the component that you can actually steer is relatively small if compared to total. But still, I mean, it makes sense to adjust it accordingly. And the main rationale behind this scheme is that, of course, the central bank faces unavoidable and exogenous risks, but it should still try to pursue an objective of capital preservation in order to support its independence and credibility. So what we do on investments, it ultimately aimed at supporting our capability to perform our institutional tasks. And having said this, our strategic asset allocation tends to move according to major long-term trends. And I can tell you that over the last few years, the mega trend was the one of the huge increase of the monetary policy related assets and liabilities, and which are euros. Basically, we bought a lot of euro-denominated securities of government bonds within the APP, within the PEPP, and so the reaction on the investment side was to increase to some extent those components which were less closely correlated with what we were purchasing for monetary policy reasons. And so an increase in foreign currencies, an increase in US dollars, an increase in equity. And of course, we have this big bulk of gold, which is, I would say, a legacy for Banca d'Italia, almost a tradition. And this is a nice hedge too. And if you move on to the next slide, I want to highlight another development which was quite relevant in our pool of assets, and namely the fact that we have been greening our investment portfolio. This is another mega trend, I would say, and it is not mechanically driven by our asset allocation scheme, but it's rather a choice, a decision that the bank made. And we have been recently issued something you may have seen. It is a responsible investment charter where we made explicit our goals in this domain, and namely the goal to promote economic, environmental, and social sustainability in the long term, mostly by leading by example, and the goal to do something really practical and material, and namely to integrate ESG criteria into our asset allocation and risk measurement, and then to publish the results. So what did we do? We have been working on this since 2019, and we mostly focused on the private components of our portfolio. So on the equity portfolio, on the 13 billion I showed you beforehand, and on the corporate portfolio, because I didn't say this before, but within our euro portfolio, as well as in the dollar portfolio, we have two small corporate components. And as far as the equity portfolio is concerned, this was perhaps our biggest achievement, because we set up a tilting scheme whereby we overweight those equities which show the highest ESG scores. So basically, it is an optimization function which, with a constraint to minimize deviation from the market index, tries to achieve a certain level of ESG score. And for the corporate portfolios, we adopted ESG benchmarks from the industry. And we also set up green bond portfolios. And now we are starting to integrate ESG and carbon intensity measures in the overall strategic asset allocation scheme. So far, we are, the material actions are taken only on the equity and corporate component. The rest is just measurement. And so, yes, I want to conclude with this to say that, a central bank with a big portfolio like us has to be dynamic, of course, has to find its own way to be dynamic. And so these are the main courses of actions that we have been following over the last few years. Thank you.
Well, thank you very much, Joyce. So again, it seems oriented to a longer term approach, which I think also chimes to some extent with what Julius was saying earlier. If only we could move back from that bumpy road to a calm highway. I think we're all hoping for that. Interesting comments also on greening by Banca d'Italia. That perhaps tees up quite nicely for the for Ellie's session in just over an hour's time. One question coming through, a couple of questions coming through, but one of which, if perhaps I could ask to Choya first, and then maybe Julius to come in on, is on gold, and we have somebody called David Marsh who'd like to chip in with a question. I think you may have heard of David.
Yep, go ahead.
Yes, hi everybody. If you can hear me now, can you? I can't see myself, but I can. I've got the feeling my voice is coming across. Yes, you made some remarks about gold, Julius, and of course we've noticed your governor Adam Klapinski has been making a lot of statements about gold in the last 6 months, and of course Italy, for legacy reasons, as you say, has got a lot of gold. I noticed with the Russian Federation Bank, they have carefully noticed that their gold is all stored in Russia itself, and so of course is more likely to be used there. Could you, particularly Julius, say a few words about the location of gold? You noticed that half of the gold is in the Bank of England, where it can be used for transactional purposes, and you seem to be taking a much more direct view now about the transactional status of gold, and given interest rates going up, I guess it's much more mobilizable these days in terms of getting some kind of return on gold than it was 5 or 6 years ago. And could you let us know in this call whether you think it's a good idea to have your gold stored in your own country, or whether it makes more sense to have it overseas, not just for the obvious security reasons, but also because it is clearly more mobilizable if it is in one of the major financial centers. Thank you very much.
Okay, thank you, David. A couple of questions there. I think, well, first of all, I think, gold investments, which in our case were mostly gold deposits, never been a major source of returns for us. I mean, it's the gold deposit rates are scandalously low, so it's never a major, it's not like a major source of income for us. But it's there. It's something we can do, and it certainly pays for in a way. If you resort to gold deposits, then in a way that covers the gold storage costs, at least. So that's nice, obviously. In terms of your other question, I think, I don't think it's a binary choice whether to keep gold here or there. I think with respect to gold, just as much as with respect to other assets, the rule is don't put all your eggs into one basket, I think. And that is the approach that we have been true to, that we've been following so far. So we've been trying to diversify the locations where we hold our gold, store our gold, and I guess that's as much as I can say about this at this point.
So thank you very much. Full marks for diplomacy, Julius. Thank you.
If you want, I can.
Or maybe there was some other question. I can't. Maybe there was some other question, but I think you had two. One about where we store gold, and obviously I said that it's partly domestically, partly internationally.
No, thank you. I think you went to the limit of what you could do. I'd very much be interested, Joya, in anything you have to say on that.
Yeah, sure. Banca d'Italia is very transparent with regard to the location of its gold. You can easily find it on our website. And we also adopt a diversification policy whereby we hold overall 2,400 tons gold, and a large component, a bit less than 50%, is located in Banca d'Italia's vault. And a similar chunk, 40-something%, is located in the United States. And the rest in the UK and Switzerland, and we mostly rely upon other central banks as custodian. And so the idea is to diversify and to be present with gold of course, on those financial locations where gold is actually traded, even though, as you know, we're very static and stable with our gold holdings, but still we think it makes sense to diversify into locations that are somehow meaningful with regard to the gold market.
Thank you very much, Joya. Please do, audience, keep your questions coming through, because there are a number of issues that are being raised. I think we could probably talk about all day, but I've certainly got a few. One that is coming through, and maybe, Joya, this probably, if I could put this to you, given your comments about greening, it does slightly tilt into the next session, but question is, has the recent rise in energy prices changed your view on sustainability? And after Joya, if Julius has anything to add to that as well, we'd be interested to hear it, before, of course, coming to Carl.
No, of course, the recent developments are very relevant when it comes, of course, to energy and to the actual possibility to maintain high standards in terms of, I'm talking right now more as a citizen than as a central banker, because it's a question I'm asking to myself almost every day. I mean, shall we manage as a country, as Europe, as a world, to pay as much attention to the environment as we have done so far? Because of course, if we have to move back to carbon electricity production because we have no other sources, and it will be hard to do so. And having said that, of course, our orientation has not changed at all. Also because, as I told you, this is really a long-term strategic course of action that we have decided to pursue. And so, of course, I think that ESG scores of companies might somehow be influenced by actual developments in the coming months and years, but we have to stick to our purposes, definitely.
Thank you. And Julius, do you have any remarks on that before we go to Carl?
Well, we've also implemented a green bond strategy. And the main premise of the strategy is that we try to maintain a constant allocation of about 1% of our reserves to the green bond segment of the market. I think, yeah, I think it's a valid point, and it's a valid question. How robust will this whole ESG push towards ESG be in the current circumstances? I think we've been waiting for a long time for some guidance on the part of European authorities on a new set of criteria for green bonds. What constitutes green? What is green? What is not green? I think there's been some debate about whether or not nuclear can count as green or not. That is beyond far above my pay grade. I'm a simple investment professional and risk manager, and I guess what we've been trying to do is what we've been trying to do is to simply protect, to as big an extent as possible, practically possible, our portfolio against primarily greenwashing. So we try to stick to second and third. We only buy bonds with second and third party opinions. We mostly buy international institutions, government-related institutions anyway. We think risk there is limited. But this is definitely a good question, and frankly I don't have the answer myself.
Yes, it's a great question for all of us, I think. Thanks guys for tackling that one. Carl, you've been very patient. You've been waiting in the wings. I do apologize, but we'd be very interested to hear your views now on those issues. But also, Carl Melindra is, of course, Head of Reserves Management Department 1 at the Banco Central Filipinas. If you could perhaps share with us, please, your thoughts on how you do day to day what you do, and also how recent and current events are, if they are, affecting how you do it. Carl, over to you. Thank you. And do keep your questions, please, coming in, audience.
Thank you, Neil. So maybe before I address those questions, I can just give a very brief backgrounder on our reserves. So next slide, please. Okay, so at a glance, our reserves have grown from about 36.7 billion back in June 2008 to about 108 billion as of February. And I just chose June because that was the time when I entered the bank. And coincidentally, that was also the time wherein some significant institutions started to have troubles. And that's when our reserves started to grow significantly as well because of the drastic liquidity by central banks. And in terms of our composition, currency composition, it's predominantly in the US dollar. And of course, we have gold. Being a country that is rich in gold, we do purchase gold domestically, and the BSP is an LBMA refiner. So I would say we are somewhat active in the international gold market. And then as to where the reserves are invested, high-grade fixed income predominantly, and there is this is concentrated, of course, in developed markets, and there is some regional fixed income markets as well because of cooperative initiatives with the BIS. And then, of course, we also have recently forayed into green bonds, and it has been made public by our governor that we have subscribed to the BIS investment pool for green bonds, and we have made a few injections there as well. And just like the other central banks, this is something that we are continuing to look into. And yeah, as to the structure of our reserves, it is tranched pretty much like most other central banks. And these are tranched by objective, wherein we would have a certain liquidity pool that may be dedicated to manage short-term fluctuations if it is needed, if FX goes out of whack. And then as to the other portfolios, these would be mostly actively managed, and the significant portion of the reserves would be managed internally by our team. And as to recent SAA changes, Despite the pandemic, we were already making plans to shift some of our allocations back late 2019 and early 2020. And then we proceeded with those changes despite the pandemic. And then in 2021, early 2021, we also made a few changes to our strategic asset allocation. So next slide, please. Okay, so the chart on the left is actually what you will see if you look at our gold holdings as shown in Bloomberg. So it's right about 5 million troy ounces at the moment. And you can see that there is very significant volatility, and perhaps that gives an indication of our domestic activities and foreign participation. And there have been numerous domestic laws that would support our operations. And we do hope that our participation in the gold market continues both domestically and abroad, prospectively. Next slide, please. Okay, so focusing more on gold, maybe just to differentiate a bit from the other central banks, we try to actively manage our portfolio. So we do spot trades. We try to position the portfolio if possible, but these are more very small trades. And then we also say sell options. So we do feel that we are covered when we do sell our options. And of course, these are also just a few trades every now and then. And of course, right now the market is excited. The gold market is quite exciting, but of course very can be a bit scary as well. And then on deposits, as noted by my colleague, it has not been an exciting market predominantly, but we still try to source a little bit of yield from our counterparties here. And we are allowed to do some swaps and loans, but or gold-backed loans, but currently we don't do those, or we haven't done those. And yeah, next slide, please. And yeah, so just to note, we have a domestic gold buying program, and the challenge is to really revive our domestic sales to the BSP, because there have been past challenges wherein there have been changes in the taxing regime, so that discouraged the sales of gold to the BSP. And there has been a recent law passed to reignite sales back to the central bank that would grant exemptions, tax exemptions to those sellers to the BSP. And of course, being an LBMA refiner, we would have to conduct due diligence for all our domestic gold purchases. Next slide, please. Okay, and very briefly, just on the governance structure on the left. So this applies to our gold reserves and also the non-gold reserves. I believe a lot of central banks would follow a similar structure. So at the top level, we have the policy set by the Monetary Board. And then the Investment Management Committee would have the tactical allocations approved. And of course, those are recommended by the Financial Markets team, where our department resides. So the Financial Markets team is composed of the front, middle, and back offices, essentially. And we also have our open market operations team here, but they pretty much operate in within their own space. And then for our allocation rationale into gold, the reasons are as listed here. And for us, a big reason is, of course, diversification. It is a very volatile asset, but when combined with the rest of the reserves, it can provide us a diversification benefit. It is a very liquid asset. Can use it for the IMF if needed. And we have good supply domestically. And the challenge is to revive that purchase from our domestic sellers. And as to how we determine our ratio, go to GI ratio. So we consider a lot of things. We try to optimize, but it's very difficult. And we look at our legacy holdings as a proportion of the international reserves. So data is available in the website if there's interest on the ratios. And yeah, we have to we also tend to look at peer comparison. So data is available from the World Gold Council, so that helps us have an idea on how much other central banks are holding as well. And yeah, so that's pretty much my introduction to the Central Bank of the Philippines, or the Bangko Sentral. Now, maybe moving to your questions, Neil, unless you have any questions to the presentation. So I think my slides pretty much mentioned what we do generally, my team. And with regard to the current environment, I guess before the unfortunate events in the last week of February, we were, I guess the markets were pretty much expecting or focusing on the Fed, even if it was more than a month away. And given that measures seem to show that inflation has been more broad-based in the US, the expectation was for the Fed to hike, and the question was how many hikes in March. So that was the problem that we were contending with, and we tried to position the portfolio tactically, although we do note, of course, that the strategic holdings would tend to look through these short-term volatilities. And now I guess the situation is significantly more problematic for us in that gold is becoming very volatile. Of course, it's good for us since it enhances the value of our reserves, and any sales would contribute significantly to our bottom line, given the very low historical average cost of purchasing gold. But now it is quite difficult to position the fixed income portfolio. So it's not, I get the feeling that it's pretty much like the first quarter of 2021 again, wherein everyone you talk to seem to be going for steepeners, and then the curve flattened significantly. And at the start of the year, people are short, 2022, but now we have to revisit these kinds of thoughts. And you also have to worry about how the volatility of yields would affect the spreads of some non-government holdings. So suffice to say, it's extremely challenging at the moment. And of course, management is keen to know how we are thinking about these. Yeah.
Carl, thank you very much for that. You joined the central bank in June 2008, so twists and turns in world economies are not unfamiliar to you. You choose difficult times to start. Thank you for describing how you feel about things currently. Before you make a decision tactically about how to shift portfolios, what is the current thinking, do you fear, from a personal point of view maybe, and also to the other panelists in turn, about whether this inflation that is the highest in many people's working lifetimes is just still transitory, or it's very real? And I say by real, I mean it's demand driven with policy implications, or it's stagflationary. It's what I would call the wrong sort of inflation, which isn't backed up by wage increases, in which case, in the past, we know from previous episodes, it tends to peter out after a while, and central banks that are too aggressive in the meantime tend to perhaps, if anything, add to the problems. And I'm saying that with in mind the fact that the dollar strip, last time I looked, was pricing in just more than 5 US moves in the next 12 months or so. So is the current thinking, perhaps from a personal level, if not the central bank, that the reflation trade may come back? And Julius referred to Tina earlier on, and that's also not without problems, but it isn't perhaps the start of a aggressive normalization process that would take monetary and fiscal positions back to where we were. I wonder if the panelists have any comments on that. Perhaps Carl, if you could go first, please.
Yeah. For me, maybe looking at the US, so measures have shown that the components of inflation on non-reopening components of inflation have been increasing. So for me, that is a basis for for tightening policy in the US, at least. Although, and on that note, perhaps it is indeed not as transitory as initially expected by the Fed. So, indeed, they themselves have recognized that. But I guess now inflation tends to be more real than ever with the rise of energy costs, and the impact on the average consumer is, I guess, more direct. And even here, for example, in our country, suddenly we see gas prices spiking significantly, and people lining up at gas pumps. So you don't see that on a regular basis. So inflation, not just in the US, but in some very import-sensitive markets as well. I guess it will become a very challenging scenario for central banks. And on stagflation, we've heard this bounce around last year, and I wasn't a believer of that. But I guess now, I guess I am neutral on that, given that there's just too many uncertainties at the moment. And just today, we see LME closing trading on nickel. So the landscape is changing every hour, and it's affecting more and more people on a real basis. So it's indeed quite challenging.
Thank you, Carl. And Joya, do you have anything to add to that?
Well, with regard to Europe, we will have on Thursday the ECB and the new macroeconomic projections. So I think it will be a good opportunity to have a thorough assessment on the latest official focus and picture. More globally, I mean, not specifically with regard to the US, but rather to the world, as Carl was correctly pointing out, I think the war is not only a major factor of uncertainty, but it is also an event which apparently points to higher inflation and lower growth, because I mean the impact of the war on energy prices, on consumption, on it is completely unpredictable. But I would say that the most immediate consequences seem to be, yes, threatening for both inflation and growth all over the world, because we're talking about fertilizers and repercussions on agriculture. I mean, it's the second, third round, fourth round effects are huge. So if we were in an uncertain world at the end of February, now we are in a much more uncertain world.
I think that sounds right to me. And what about you, Julius? Any thoughts on that?
Not exactly on an optimistic note, I'm afraid. I can only echo what has already been said. Perhaps stressing that, well, I think what Joya said was spot on. I mean, we have ahead of us, we have some very dark and difficult times with high inflation and potentially low growth on account of the war and supply distortions, and so we're going to see we're going to see the worst of COVID back, with no end in sight, no clear scenario for improvement. And I think I think inflation is not going to be transitory. It's not going away in a month or 2 or 3 months. And I also think it's very, especially the growth picture is going to be very heterogeneous. I mean, if you look at the behavior of US versus EU equity markets, and also if you look at the behavior of corporate spreads in the US and the EU, it's a completely different picture to what we've seen during the COVID. During the COVID pandemic, spreads on US corporates, and I'm talking investment grade, so high grade corporate bonds, have widened significantly, jumped much more significantly Now the situation is reversed. It's Europe that is having a high widening of spreads, and U.S. corporates are faring significantly better, I would say, which is just as well because we only hold U.S. corporate bonds in our portfolio. But more worryingly, I think this suggests that Europe, because of its stronger reliance on energy exports from Russia, and also geopolitical proximity, it's much, I would say, more vulnerable to the crisis and the more general fallout from the crisis. And it's less, U.S. is probably better positioned to withstand the shock, and therefore I would venture a guess that perhaps U.S. the Fed will proceed with the tightening, maybe scale down a little bit, but we're likely to see some tightening of financial conditions in the U.S. I would argue, maybe later this year, but I wouldn't expect the same from the ECB.
Thank you, guys. The needs to be that monetary policy is tightening, and I guess with that too, at some stage, fiscal policy. So perhaps let's hope that the underlying inflation in that respect is demand fueled as much as it is cost fueled. Otherwise, it may be another bumpy road going forward in terms of correction down the line. We've got a couple more questions coming through, which is great because we are coming into the final leg of our session. One again is on gold. So sorry to return to gold, but you can see how important that is to the audience in terms perhaps of inflation expectations. The question is, are the panelists surprised that gold has not risen more given the geopolitical events? If yes, what is your explanation of this relatively small rise? So we are asking you to be gold experts here. And there's a second question, which is market distinctions. Are they exhaustive? Two segments, high grade fixed income and regional fixed income. Is there an opportunity or possibility for another fixed income band? Have there been any thoughts around this post-COVID? So please take either of those questions if you could, panel.
Sorry, could you please repeat the second one? I didn't really get it in full.
Yes, it's perhaps I'm misreading it. Perhaps the sender could resend it if you can. But market distinctions, are they exhaustive? Two segments, high grade fixed income and regional fixed income. Is there an opportunity for another sort of, I guess, fixed income definition? I said we touched upon green bonds. Have there been any thoughts around this? Perhaps the questioner could perhaps send me that question again. I think I'm misreading. But the first one is about gold. Are you surprised it's not risen more given geopolitical events? If yes, what is your explanation for this relatively small rise? I wonder if the questioner is hinting, but I don't know, at whether the inflation scares maybe are not as sharp as we think they are.
I guess well, it's a very good question, and it's always easier to concoct some answers and after the fact rather than while you're living through the actual events. But for what it's worth, I'll just throw in some ideas, and then maybe some of you will agree, maybe some will disagree. How about if we think of it, I mean, maybe, just maybe, the market is treating this, I mean, so the presumption is, okay, we're going through a geopolitical crisis, so we should see gold price going through the roof. And it's not. I mean, it's high, but it's not as high as one might have, let's say, expected. And it's quite interesting that we see similar things across different markets. So if you look at instruments that pick up exactly what you would expect to pick up credit risk component or geopolitical risk component of credit risk, they haven't repriced quite as much. What you're seeing definitely is increase of all instruments that proxy for inflation risk instead. So if you look at commodity prices and commodity ETFs and commodity stocks, and if you're looking at so inflation expectations. So a consistent picture seems to be emerging here, that perhaps the market is treating the geopolitical fallout of the war as perhaps contained or limited to Russia and Ukraine. And the main risk that the market is pricing in is the risk of simply higher inflation. So you see all these products that are well positioned to benefit from higher energy and commodities prices are increasing. Perhaps gold is more consistent geopolitical spike in geopolitical risk. I mean, we're seeing this, for example, when you're looking at the behavior of the Polish zloty, of exchange rates. You see clearly that the zloty has lost quite a bit, probably like 10% in the space of 1 or 2 months or so, even though credit default swaps as such have not risen to a similar extent. So there seems to be an inflation story unfolding, and perhaps gold isn't picking that part of that story so well. But that's just an idea there for everyone to discuss. I'm not sure if it's a correct guess, but it's a guess.
Yeah, if I may, my reading, to some extent similar to the one of Julius, but with some nuances. And namely, I would argue that not only gold, but all traditional safe havens behaved in a fairly similar manner over the last couple of weeks. And namely, they rose moderately because the gold rallied to some extent. The dollar rallied to some extent. So from 112 to 108, treasuries rallied to a moderate extent, 20 basis points, 30 maybe in more extreme situations. Bonds rallied to some extent. Core, non-core European spreads did not widen at all. So it was not a traditional risk-off move. Well, equities behaved very badly, but equities are, in my view, more connected to the second leg of the move. So what happened? Those assets that are more closely linked with material developments in Russia and Ukraine moved sharply. So gas prices ballooned because it's directly affected. Oil prices as well, not to the same extent, but still. And other commodity prices because they are directly affected. Equity prices collapsed sharply because several companies and several sectors are heavily and directly affected. So I would say that we saw a moderate traditional risk-off move coupled with a sharp move of those financial assets that are directly connected with the crisis in terms of location, in terms of sectors which are directly hit. This is my reading.
Thank you, Joy. And Carl?
Yeah, hi Neil. Actually, I have a bit of a different take, as in my view, gold has been a bit strong. I mean, it's up already about 10% in 1 month. So it's a relative thing. I mean, for me, that's significant, but I guess for the one asking the question, it's not a significant move. So yeah, for me, it's sizable, and there is a huge potential for further increases, it seems.
Thank you, Carl. I just wonder actually if it's a slight silver lining in that I remember well from the early part of the Eurozone crisis that gold did rather well, I guess not because of inflation reasons, but because of perceived default reasons, whether or not they were right or wrong. And gold often is a double-edged sword in terms of being a hedge for both of those things. So at least perhaps default risk is not perceived across the world to be picking up, in which case I suspect gold might do even better. We've got two great questions on the chat, and we're in the last leg coming up, so that's terrific. But do squeeze in any more that you may have. One is on fiscal policy. To what extent did the large stimulus packages in response to COVID play a role in heightening inflation? I say fiscal, there was of course QE and monetary as well, but fiscal perhaps is something that we haven't touched upon too much, though that may be a dangerous area for central bankers, of course. And the second one is on the renminbi, and nobody mentioned the RMB fixed income as a diversifier of FX reserves. The recent targeting of the Central Bank of Russia reserves makes it more risky to invest into RMB fixed income, given the geopolitical events surrounding China. So two questions for you to select, please. One is about the large stimulus packages. Have they worked in terms of at last heightening inflation? And secondly, the role of the renminbi as a diversifier. Who'd like
I will
to go?
pick the second one because I actually forgot something, namely that I didn't tell you that Banca d'Italia has a small RMB portfolio, which is small, and so it can't be considered as a diversifier. But still, you couldn't see it in the slides because it's a little slice, but it's a portfolio that we built up in a view to explore the market a few years ago and getting familiar with it, and also in light of the increasing importance, of course, of the Chinese economy, of China in the market. And we would not rule out a growth of the portfolio in the future when the market becomes more mature. But this is not really a theme for now as a major diversifier, but still we have one.
If I can jump in, just like Joya, the central bank of the BSP is also invested in RMB, and we have been in the market initially offshore and then onshore for the past 8 years or so. Although it is a diversifier, but internally there is no discussion on ramping up holdings of RMB fixed income. But I guess we can easily say a lot of political things here, but I'll keep it there.
Thank you, Carla. Then you take us for the first question about the extent to which stimulus into COVID and during COVID has contributed to these inflation expectations, or are there other forces at play here?
Well, our experiences in Poland, at least in Poland, and I'm jumping into the role of central bank chief economist here, but I would say our experience was that certainly the fiscal packages adopted to counteract the adverse economic impact of the COVID did play a role, but they contribute a relatively minor share of the overall inflation that we're seeing. So if we're seeing inflation of 7 or 8%, perhaps fiscal packages 1 percentage point of that. Just ballpark of the order of magnitude. So don't quote me on that, but this is the degree of the. And of course, to some extent, this is what we hoped for, right? So if you're implementing a fiscal package, you're doing this to stimulate growth, so you're bound to see some pro-inflationary impact. But certainly, the inflation that we're seeing is not driven by the fiscal packages. At least that's our experience. It's much more. It has much more to do with effects and more directly commodities prices, gas prices specifically.
Yes, of course, and also I guess it wasn't rocket science to assume that as we all came out of lockdown at different stages and different points, then pent-up demand would take off and supply chains would be ruptured. So there was bound to be surely at least some initial inflation going forward. But what it means for policy, we shall have to find out. I've received again the question we got earlier, and again, apologies, maybe I'm misreading it.
But again, Neil, just as yeah, but again, if I may just jump in real quick, it's so easy to rationalize this. I mean, ex post, that is the unavoidable. I mean, it seems to us, of course, inflation had to pick up. That seems like a no-brainer. But I do remember these discussions early on in 2020. Where nobody knew, and the question was, okay, so on one hand, sure, we might see we might see some backlogs, some bottlenecks, some. On the one hand, we have this this supply shock. Then on the other hand, we have demand that wasn't clear how it's going to play out. So I would say it's ex post. Sure, it's easy to make a case that inflation had to increase. But as I go back to the beginning of the pandemic and the stories we were trying to tell ourselves to sort of rationalize what was going on, the picture wasn't all that clear at the time. I don't know what inflation were you forecasting for 2020, for 2021? Sorry, for 2021, back in 2020.
Well, it's a great question, Julius. My get out there is the fact that I was and I am in a Brexit country, and when we were considering potential shortages, we thought, I think in general, that that inflation would be returning to some extent, but having a rather long memory, not quite as long as David Marsh's. I would say that in my view, where we're going with inflation may not return to the sort of problematic times of the 1970s, at least in the UK. But David may correct me on that. Guys, the time has gone very quickly, and we are coming towards the end. I don't know if the panelists want to make any wrap-up points. And I've got a few to make if they don't. So please give me the thumbs up or jump in now, guys, if you'd like to make any summary points to what I think has been a very worthwhile session.
Neil, maybe for me, just some thoughts moving forward. So we've been talking about more near-term thinking, but maybe long-term for reserve managers. I'm not sure if this will incite discussion among central banks or within central banks, if there would be a need to really assess currency allocation because of the sanctions that we've been seeing. Gold, you thought was safe, but I guess the LBMA has put its hand down and has sanctioned or really removed some of or all of the Russian good delivery refiners. So I think this may prompt central banks to assess currency allocations moving forward. But of course, we're all operating as honest reserve managers here, so we would expect not to be sanctioned. But perhaps some people will rethink their allocations. Yeah, that's it for me.
Carl, thank you for that. Which is absolutely right, of course, given that the FX dimension is just a big chunk, is such a big chunk in general, I guess, of total returns in managing portfolios. So I think that's something we should discuss and come back to at a later stage. Very, very good idea. So I think it's been an extremely worthwhile first half of this match to allow everybody to go away and enjoy a halftime lemon, as we do in football, at least in the UK. Just three takeaways from me. First of all, it seems that the message I'm getting is that for the central banks we've spoken to, it's still very much a long-term game, though of course asset allocators need to be nimble. The second thing really is that I'm picking up, not just in this session, but in other sessions we've had in the last week or two, that the base assumptions from most is still that the US Fed and other central banks will continue their journey towards what we might consider to be some sort of neutral or normal policy rate going forward. That's in general. And the third thing is, of course, in the meantime, there are other issues that go beyond the current tragic events, such as green issues and climate change and the building of yield curves, which Joya and other central banks have been active with and will be involved in. So from my point, I'd just like to thank our brilliant panelists, Joya, Julius, and Carl, for their comments. Not all easy questions for central banks, but I thought dealt with very deftly. I'd also like to thank our audience for your participation and excellent questions, and ask you all after the break in about an hour's time to join my colleague Ellie Groves for more discussion on ESG and other related issues. But for me and the panel, I'd like to thank you very much and wish you a good day.